Welcome to the Family Banking Show with your hosts Rob, Derek, and John, where we dive into the world of the infinite banking concept and discuss personal banking strategies to secure your legacy and build generational wealth. We're glad you're here, and we hope this episode serves you well.
If you're interested in learning more about setting up your own family banking system, send an email to thefamilybankingshow@gmail.com. We'd love to hear from you.
Welcome back, ladies and gentlemen, to the Family Banking Show. We are your hosts, Derek, Rob, and John. As we get started with this episode, I'd like to ask you to be sure to like, comment, or subscribe to whatever platform you're listening to us on. That really does help us quite a bit trying to get this message out to other families throughout the United States. So if you would be oh so kind to help us, we would greatly appreciate it. Guys, how's it going this week?
Good. We are coming up on Memorial Day weekend, so that's always a long weekend coming up. So looking forward to hanging out with family and friends. Gonna do some golfing this weekend. First
Nice.
time of the year. That's probably gonna be very embarrassing.
Rob, I didn't know you golf. Is that something you've
I don't. That's why it's gonna be very embarrassing.
just chipping grass, really?
Yeah.
Well, one of my motivating factors is all my cousins are going on a golf trip in October, and during the NFL draft, it's funny, they went out. They're all brothers, and and one brother-in-law, and they went out and they had six people last fall. And if you have six, they add random people to your parties,
Yeah.
and they're like, oh, that's not as fun. So we need to draft two new quote unquote brothers into the group. And I'm really close with these guys. I actually stayed at their house when I was in college for my first 2 years in college, up in the attic with no insulation and snow puffing through the the upstairs window, covered in blankets. I can just remember being covered in blankets doing calculus until 3 a.m. up in their attic. But they were all young kids and like really close cousins. But so they sent me a group text, with the 2025 draft, we select Rob Herkus to join the brothers golf trip, BGTY or something like that. So it was really fun. Anyway, it's in October. Like, oh man, I gotta golf a little here so I don't embarrass myself. So I'm starting my first embarrassing moment this Saturday,
Nice.
and hopefully it'll get better throughout the summer.
Well, you're braver than I am. I don't think I'd ever step foot on a golf course.
It's fun
Unless it's
too,
mini golf.
right?
Definitely takes some commitment. For me, it's like I hate being bad at things. So
Oh,
it's
me
like
too.
if I know I'm going to do something that I'm bad at, I need to like mentally go in. I'm going to commit this amount of time until I'm at least like adequate at it. And
Yep.
golf just takes so much time. I think it's like
Right.
how long does it take for 18 holes? Like 3 or 4 hours
Yep.
minimum.
Yep. Yep.
Yeah, with two toddlers and with crazy stuff going on, it feels like maybe a different season, but I'm
Yeah.
sure you'll end up, being pretty good.
Well, that was my I'm the same way, John. Like if I'm not good at something, I hate it. And I've tried and failed at golf so many times, and then you just throw the clubs into the trunk and like I'm not touching this for years.
Yep.
It's just
I don't want to
it's
see
a
you
hard
again.
game.
Yeah.
Not for me. I've done top golf and I can't stop shanking right. I don't know what I'm doing wrong. Doesn't matter. You could
Yeah.
tell me a million different things and it won't fix my problem.
Yeah, they call that a hosel rocket because right above the head of the golf club it's called the hosel. The hosel
Okay.
connects the head to the shaft. So a hosel rocket, you hit this above, you miss the ball with the face, and you hit the shaft right at the connector, the hosel. So it just
Just goes
takes off.
soaring.
Mhm.
Well, that could be my issues. So, all right. Well, good luck to you, Rob, on the golf course,
Thank
and
you.
everybody else. Wear a hard hat.
Right? Yeah, four. A lot of that.
Yeah, I always think it's interesting that people that want to live next to a golf course. I'm like, man, you put a lot of faith in some of these guys.
Hmm. For sure.
But I'm sure. Anyway. All right. So in this episode, guys, we're talking about the multiple returns on your dollars using the infinite banking concept. And so what we're just high level, what we're talking about is can we, or you may have, as you've studied the infinite banking concept, heard that you can generate multiple rates of return on your dollars. And that's one of the initial appealing things to those of us who are maybe a little bit more financially savvy. That sounds great. Obviously earning returns in more than one place at one time on the same dollar obviously is going to increase your overall return. So guys, talk to me about this. What's your initial thoughts or reactions to this idea? Can it be done? And then we'll get into maybe what are the three rates of returns that can be leveraged using infinite banking.
Well, I guess the initial answer is yes, it can be done. That's one of the, from a high level, that's one of the things that was really blew me away when I first learned about the infinite banking process, reading Nelson Nash's book, recognizing that, not only can you get a rate of return, like a growth and a rate of return, a grow on your death benefit, a growth on the corresponding cash value. It's guaranteed, but you can then borrow against it, and then you get a death benefit, so it's like, wow, so for the same dollar I'm spending it, putting in, I can get more, three returns on that dollar, so to speak, versus just putting it into a simple savings account. So it's like, why would you not do that? It really was like a kind of moment.
Hmm.
Yeah, I think the big kicker for me is efficiency.
Hmm.
It's like if I'm gonna have a dollar sit somewhere, like
Yeah.
what's gonna give me the most benefits or what's gonna be the most
Hmm.
efficient use of that dollar. So that's one thing that I think is really important to understand is like something that you're already probably gonna have to pay for. You pay for it one way or another. Either you pay for it while you're alive or after. Is life insurance at its
Hmm.
core. I think we all need it to a certain extent. So that's one thing like I want my dollars to do. And then another thing I want my dollars to do is save and grow. And then
Hmm.
other things I want my dollar to do is, purchase assets or capture the things that I would finance in life. And so all these like needs that I have throughout my life, I want to know like can this all be kind of wrapped into one single thing or do I have to segregate it and allocate separate dollars for these jobs? And that's one of the ways I approach it is just can I make those dollars efficient? Can I bundle some of these things without sacrificing any of these significant needs that I just mentioned? So that's kind of the way I approach it.
Yeah. Yeah. So as we begin to think about the different rates of return, inside of the whole life policy, it has its own internal rate of return, which
Hmm.
is relatively competitive compared to other like equivalents. And oftentimes you might be hearing between 3 and 5%, depending upon the insurance carrier and some of their past performances. So, guys, talk to me a little bit more. What is this internal rate of return? How is it calculated? How does the insurance company even generate this return? Go into that a little bit deeper.
Yeah, the IRR internal rate of return, or IRR. That's like the one true way of comparing the rate of return of two different assets. And the simple way to describe it is that you start at a starting value, and you have an ending value over time. And then the number of years between, what would be the rate of return on that money to get from value A to value B? Divide that up by the years. That's your internal rate of return. That's the true amount, that's the true rate of return of that asset each year, every single year to get to the end point. And so that's like the real way to compare two assets and what the rate of return might be. And this is actually one of my favorite things to do is because when you plug in, I use Todd Langford's truth concepts calculators, and it calculates the internal rate of return for you. And one of the calculators I love the most is called funding calculator. It compares like a savings account versus the cash value growth of an infinite banking style policy. And I'm actually having up on the screen right now. The policy itself, in and of itself, And also the cool thing about whole life policies is they have a guaranteed rate of return that it's guaranteed to go up. And that's usually between, 1.3 to 1.6. That's the guaranteed rate. That's before the dividends. That's before the profit comes back from the insurance company. If it does, it's not guaranteed. But but the companies we work with have always made a profit and they've always returned it back to their shareholders, not shareholders, policy owners. And so that internal rate of return that is guaranteed is the bare minimum. And even at 1.5 or 6%, that's not bad. I mean, that's just like what you'd get in a way better than what you get in just like a standard basic savings or checking account. So that's actually really good just in and of itself. Then you get the profits that come back that we then design these policies so that they purchase up more death benefit, which then returns more cash surrender value. So then you get that growth, that cash value growth
Yeah.
has a rate of return, internal rate of return. And I'm looking at one right now. When I just plug it in as is, starting, for 40 years, it's got an internal rate of return of 4.97%.
Yeah.
As that's before even factoring in tax-free, because that's the other thing you need to factor in is what is the impact of it equivalent to another asset like a savings account? You got to factor in taxes. And so you plug in taxes, it's at 7 point for this particular client because he's at a 32% tax bracket. It's equivalent to a 7.3% rate of return of a savings account every single year for 30 years to match the growth, the cash value growth of the policy. So it's really eye-opening.
Yeah.
And when you look at it just from a rate of return in terms of cash value growth.
Yeah.
So it's really, really good.
Yeah. It's one of a kind when it comes to the
Hmm.
risk profile uh,
Yeah.
you're getting bond-like returns without the drawbacks of having bonds in your portfolio. So
Right.
yeah, very, very powerful and a good
And
explanation.
that's just return one. And
Right.
that's like
Yeah.
if you just want to do rate of return of like assets,
Yeah.
it's very competitive, if
Yeah.
not better.
Yeah, John, any comments there about the internal rate of return of a whole life policy?
Yeah, I'll just foot stomp like assets, right?
Hmm.
Not an investment, not
Right.
real estate, not stocks, like
Yep.
savings. It's your under your mattress, your high yield savings account,
Yep.
just a standard checking account. Like that's what we're comparing it to. And I have never seen, and historically, I don't think there's ever been a 7.5%. Well, maybe back in the high interest rate in the 80s with
Maybe.
stagflation and everything, but definitely not every single year, right?
No.
So like that's what we're comparing it to. That's the important piece that I wanted to foot stomp.
Mhm.
And again, like Rob said, that's just number one. That's the first
Yep.
job it's doing is it's growing for you, guaranteed, plus very likely and probable profit surpluses that we're getting on top of the guarantees.
Yeah.
Yep.
So I'll just roll into number two is what do we do with that dollar in parallel with its growth that we just talked about with that IRR. And this is the power of leverage, right? I'm sure many people in the real estate world and just in investment spaces love the idea, and especially in business, love the idea of leverage. That typically involves using a commercial bank, right? It's just leveraging the value of an asset to have as collateral to purchase, a loan or get a loan for that purchase and so forth. But really, like that is much more risky, much more out of our control than what we're talking about with leverage. It's almost untrue. It feels to me to call it leverage, but it technically is leveraging the cash value
Yep.
Hmm.
to purchase X, right? And this X, I think, is really important. We generally don't say that you should purchase gas, groceries, just your daily, monthly
Right.
expenses that aren't going to produce a return for you, that aren't going to like those are just your daily expenses, sunk costs, right? We say this thing that you're leveraging the cash value to purchase, ideally, is an opportunity, something that's going to produce cash flow, something that's going to produce in and of itself its own rate of return.
Hmm.
So An easy, common example, most people have read Rich Dad Poor Dad, is real estate, right? So if you have this 5% tax-free growth in your cash value, that then you don't interrupt, that it continues at its full amount in parallel with leveraging to purchase, say, a real estate asset that's going to also maybe a 10% cash flow, cash on cash return. You're getting those two things simultaneously for the $1 that you put into your policy. So that's
Oh,
what we mean by multiple returns on the same dollar. So I just went into number two. Do y'all have anything else to say about return number two?
Yeah, I would, real estate is one that obviously makes a lot of sense for people. There's tons of reasons just to be a real estate investor in and of itself, but to couple it with the infinite banking concept is where um, it really does start to catapult you to the next level. And you're getting so many more benefits other than having the requirement to use a commercial bank or third party lender or hard money loans. You've now stored up all this equity inside of your policy in the form of the cash value that you can tap into when those other sources run dry. So if you need to, you have created your own private banking system. That's what
mhm.
makes this very, very powerful. Yeah, Rob, any other thoughts about utilizing the policy loan and the return that it's generating?
Well, that's just like, there's so many benefits to mutually owned dividend paying whole life insurance, especially how we've been trained to design them. So you have the early cash value that you can then leverage. You can borrow against that for opportunities, emergencies. It's just the peace of mind you get when if you have this ever-growing pool of capital, the peace of mind that you get that you can get to it without anyone preventing you from getting to it. So you don't have to ask a banker and prove that you're worthy to get it. You just call up the company and say, I need it, and they say, where do you want the check sent
Yeah,
or direct deposited?
yeah,
And so that peace of mind and control you get is just it's hard to describe that. It's like it has value. It's just but hard to describe that peace that comes with that control and knowing that you're partnering with an institution that's been around and profitable for the last 150 to 200 years.
hmm
It just adds a lot of peace to your life.
yeah. And the options that it offers you,
Hmm.
I've looked at using my policy loans for purchasing a business,
Hmm.
from doing real estate development. I've purchased cryptocurrency with it. I've done stock options with it.
Hmm.
So there's a lot of different avenues of potential wealth building that I have had the potential to take advantage of just because of having equity inside of my insurance policies. That if that was in an IRA or 401k or other sort of investment vehicle, I wouldn't have all of that flexibility. Sure, maybe there's things such as self-directing, but um, it doesn't give me as many options, flexibility, and protections and guarantees that I have compared to my own family banking system.
Yep. And then just to like put a little bow on that, like when you are taking those policy loans out, of course you're borrowing the insurance company's money, so they're charging you interest on it, but your policy grow is still growing
Yeah,
uninterrupted. But if you'd have been someone would say, well, you could do the same thing, you just do it from your savings account. Well, that's true. But the moment you take the dollars out of your savings account, it breaks compound growth curve of that interest of that savings account.
yeah,
So you're just paying the difference in interest between what you're gaining in your investment versus what it costs you with the insurance company. But that growth curve keeps continuing uninterrupted. That's just such a powerful component of accelerating that wealth growth that people don't see that, and that's what we're trying to, get across to folks that there's a smarter way to do it.
yeah. And even just thinking about, if you were to try to leverage your stock portfolio,
Hmm.
and you wanted to go to your local bank and say, "Hey, I've got maybe $100,000 in this portfolio. How much will you give me as a loan against that portfolio?" It's going to be way less
Yep.
compared to how much you can access in the form of a policy loan from your insurance company. Just because they have to be, it's almost like a margin account
Right.
at that point to where, you might only get 30% of it in available equity, so yeah, you're trying to do what the infinite banking concept is allowing that uninterrupted compounding. But in reality, the amount of equity addition, the amount of total value that you would need in a stock portfolio to get something equivalent to an IBC policy in the form of the cash value, you're going to need 3 times as much in that stock portfolio.
And the interest rate is going to be way higher. Like it was what 3 months ago,
Yeah.
checked it against what it would cost to get a loan against your like a mutual fund.
Yeah.
The cash value or the value of them, it was like 12%.
Wow.
So yeah, it's just stupid. Don't do that.
Even some people, they like to tap into their home equity lines of credit, and I think there's an opportunity there, or there could be an
Mhm.
opportunity there. Um, but it just keeps coming back down to is, well, how much equity are you really leaving on the table? Because, they're not going to let you take
Right,
100% out or even 90% out.
right.
So yeah, there's an opportunity to be had there just by having access to your own banking system. All right, guys. So the third rate of return is the death benefit. And some people have heard, well, when you die, the insurance company only gives you the death benefit. They don't pay out your cash value. So let's first dispel that myth a little bit and then talk about the rate of return on top of the death benefit, or, how do we calculate the rate of return with the death benefit?
Yeah, the death benefit is, I think, one of the most overlooked benefits, in particularly, honestly, in becoming your own banker. And he talks about your need for finance is much greater than your need for protection throughout your life. If you solve for the financing, then protection is kind of an icing on the cake type of thing. But that is huge, especially for a lot of the people I work with who are maybe single income. The father makes the money, the mom stays home with the kids, and there's a lot of like need for that peace of mind and protection as you're building wealth and as you are solving for your need to finance the things of life. Again, like it's something you need anyway. And the question is, do you need to allocate $3 different to put something in a growth vehicle, but then another thing into an opportunity, and then another thing into death benefit? Or can you wrap it all in the same thing and truly get these three, at a minimum, three significant benefits for the same dollar? And so that's something I find overlooked more often than not in the infinite banking community. And I think it's an incredibly powerful tool or aspect of infinite banking.
Yeah, totally. Yeah, that rate of return that if we want to look at it as a rate of return on the death benefit is massive. While you're talking, I looked at my calculator again, and let's say that's the beauty of a whole life. So you don't get death benefit with a savings account.
Right.
You don't get uninterrupted compound growth with a savings account. You don't get the privacy and tax-free growth you don't get that with a savings account. It's all these things you get with mutually loan dividend paying whole life insurance. And then you get that early cash value that you can access when you work with us to design it so you can have that early cash value. But that you pay your first premium deposit and you walk out the door and you get hit by a bus. That is a 3,243% return on your money, right? I mean, there's the factors that you get, all the benefits that you get with whole life insurance that nobody is aware of. And it just is like, I want to shake the camera. People, wake up. I just want to shake the camera. Yeah, it's the so that like so that's the first most important piece of it. Everything is derived from the death benefit. The cash value is derived from the death benefit. The comp, the returning of the dividends back into buying more death benefit, which gives you that more death benefit, which gives you more cash value. So that's that uninterrupted compound growth. It's all derived from the death benefit. So yeah, it's perfect. You get the a really, really good competitive internal rate of return. You get to leverage that compound, leverage that without interrupting the compound growth. And then you get the death benefit from day one. The moment you pay the deposit the check, you're protecting your family. It's for the same dollar. Why would you not do that?
Yeah. Yeah, so the rate of return of the death benefit is always greatest the day after you pay your first premium.
Yep.
And then as you age and as you continue to pay your premium, the rate of return relative to just the death benefit does go down over time, but
Right.
you're getting more access to the cash value along the way. And unless
Yep.
you live to 121 years old, your death benefit will always be greater than your cash value. And so for our listeners who are thinking about, well, which one do I get? Do I get the death benefit or do I get the cash value? Well, you have access to cash value as long as you're alive. But the insurance company pays out the death benefit, which is the greater of the two, unless you live to be 121, which I don't think there has been anybody that's lived that long, at least not in recent history. But the death benefit is always the best option. When it comes time for the insurance company to pay out, you of course want the greater number for your future heirs and loved ones to have access to. So yeah, great ideas here, guys. Great conversation on the 3 rates of return. Once again, to our listeners, if you wouldn't mind liking, sharing, subscribing, helping us out with the algorithms to boost our content to reach more people, we greatly appreciate it. And if you're interested in learning more about how to get started with your own family banking system, you can reach out to us at thefamilybankingshow@gmail.com, and we would love to help you and your family in any way that we can. All right, guys, we will see you in the next episode.
Sounds good, guys. Have a good week.
Thank you for joining us. If you're interested in a conversation about anything we've discussed, you can find our contact information in the show notes below.
And subscribe, follow, and leave a review to help spread this message and to help families across the country discover the generational blessing of IBC. May God bless you, and we'll see you next time.